There's a couple different ways to use them. A lot of traders use them to try and trade in between, buy when it hits the lower band, sell when it hits the higher band. That's one way to use them. Another way
Welcome back, traders and investors. We have Brent Steenberger on the line. He is the author of The Psychology of Trading. He has a PhD and is a clinical associate professor of psychiatry and behavioral sciences at SUNY Upstate Medical University in Syracuse. Brett, how you doing today?
Doing well, Joel. Nice to be here.
All right. Well, thanks for coming on. We've been talking a lot about the psychology of trading. It'll be great to get your take on it. So, how did you get interested in this field?
Well, I've had an interest in financial markets since the late 1970s and have traded those markets since then, but had a full-time career as a psychologist teaching in a medical school. Eventually, I decided to put those interests together and write my first book, the book on the psychology of trading, and that led to working with traders in Chicago who are market makers in electronic futures, and later led to working with portfolio managers in hedge funds and traders at investment banks. So I put two interests together, and they came together nicely.
Yeah, they sure did. So what kind of research did you do? You did 3 books. Is The Psychology of Trading the first one that you did? What kind of research did you do?
Well, I do 2 types of research. In writing the books, it's applying research in psychology to the performance of traders and portfolio managers. So I'm looking at the psychological factors that influence performance that have been documented in research literature, and then apply that to how traders and investors can perform better. The second type of research I do is on my blog, which is Trader Feed, and that's more research about the markets themselves, looking at patterns of strength and weakness and what those might tell us about the future of price movement.
And what are those factors? You mentioned 3 factors that you study. What are those 3 factors?
3 factors with respect to
your research.
To traders.
Yeah, well, you said when you're doing your research, you do it a 2-tiered approach. One with looking at traders, and you analyze. I thought you said 3 factors, and then you also analyze the markets. I was just wondering what those 3 factors were.
Well, some of the factors that influence traders in their performance. One that's well documented in the psychology literature is the emotional state of the trader. There's quite a bit of research that suggests that people are not great decision makers under conditions of risk and uncertainty. And so part of what I work with traders on is how to keep a level head when markets are not so level in their behavior. A second factor that's quite important is cognitive style. How do people process information? Everyone is different in terms of how they input information, how they make sense of the world. And many times traders, portfolio managers, don't really draw upon their strengths cognitively in their performance. And so I try to help them understand how they think best and how they can apply that to their trading performance. And then a third factor is related to the emotional state, but it's really the positive side of emotions. And one researcher, Barbara Fredrickson, has called it positivity. How much positive emotion do we have in our lives? How much positive emotional experience? It turns out that having positive experiences is extremely important to creativity and extremely important to productivity. So that it's not just about minimizing stress, it's about maximizing the positives in our lives.
Okay, and now going to the markets here, you said you analyze patterns, and there's fear and there's greed in this market. Are there particular chart patterns that you look at, or volume, or what do you pay? And you also said that you do your own trading. What analysis techniques do you like to follow in your own trading, and what do you study as part of your?
Yes, yes. If anyone wants to check out my Trader Feed blog, I think they'll get a sense for that. One of the things I look at, not so much chart patterns, but the breadth of market movement. As I like to say, a rising tide lifts all ships. And when we see markets going up, but individual stocks not participating, then the ships aren't rising, and we have to question the tide. And that happened recently as we moved from June to July. The breadth of the market tailed off meaningfully, especially in the smaller caps and the mid caps. And that led to a decline into early August, and then we saw weak breadth following in September, and that's led to the most recent market weakness. So looking at the breadth of market movement, I find to be particularly important. There are several other factors that I've written about on the blog that are also important, including sentiment, volatility, and the correlation among stocks.
Okay, so you work with prop firms, investment banks, and hedge funds. Do you pretty much go with the same approach with all these three different groups, or do you feel that or do you adjust your approach accordingly? Prop firms and hedge funds, I mean, they're they're different aspects. Your prop traders may be short term. Do you have one stable way to approach things, or do you approach different traders and different groups of traders in different ways?
It's a really good question, and you really have to not only approach different groups of traders differently, but you have to approach each individual trader differently. There are many different reasons why a trader or a portfolio manager might not be performing well, and so you really have to dig and find out, is it a problem with their trading approach? Is it a problem with their psychology? And if it is a problem with their psychology, what type of problem is it? It could be something in their personal life that's interfering with their performance. It could be some problems they're having in their trading process where they're just not generating creative outputs. So you really have to look at people uniquely and treat them uniquely. That being said, the general approach that I take is called a solution-focused approach. And what that means is, instead of looking solely at the problems that a trader has, I like to look at their strengths. I like to look at what they're doing well in markets. Because if we can find out what makes you money, what makes you successful, perhaps we can reverse engineer that and help you become more consistent in doing that in the future.
Okay, so different approaches for different traders. So that's interesting. So you've written 3 books. We talked about the psychology of trading. What are the other 2 books you've written?
Well, Enhancing Trader Performance is about the learning process in trading and how ordinary traders become expert traders. And the 3rd book is The Daily Trading Coach, which is really a cookbook of psychological techniques that traders can use to help themselves. And my 4th book, which I'm writing right now and which I hopefully will be done with at the end of the year, is called Trading Psychology 2.0. And that's looking at the research in psychology and applying that to the process of trading. So how can we draw upon research to become better traders day to day in how we approach our work?
We got a question coming here out of the chat room, and do you look at the tick at all? I mean, you talked about that as part of your process. Could you give us a crash course on how you interpret the tick?
Yeah, the NYSE tick is the number of stocks in the NYSE universe that are upticking minus the number that are downticking at any moment in time, and that's updated multiple times per minute. So it's a very short-term measure of strength and weakness. And so one way of utilizing that is to see over time if more stocks are upticking versus downticking. Generally, if you're going to get a trend day in the market, where the market opens near its low and closes near its high, or a downtrend, it will open near its high and close near its low, typically you will see very strong or very weak behavior in the NYSE tick. The reason the tick is a relevant and important measure is that to get many, many stocks upticking or downticking at one time, you have to have institutional participation. It really gives you some clue about whether the large participants in the marketplace are leaning on the buy side or sell side. On the other hand, if the tick is oscillating around zero with no discernible trend, then you tend to get a range-bound market, and that's helpful for a short-term trader to know.
And then also, could you just discuss the extreme readings in the tick? Doesn't it get over 1,000 on the positive side and negative 1,000 on the negative side? Aren't those pretty good short-term indicators for a top or bottom in a quick move?
Well, you can backtest these things and really find out. I know a number of people like to say that those are such extreme readings that we'll back off, but what often happens when you make an important low in the market is that value-oriented participants will come into the market, big ones, and drive the tick quite a bit higher, and so you'll get some extreme positive readings. And coming out of a low, that actually shows positive upside momentum. And so you don't want to mechanically assume that a very high tick means that we're overbought or a very low tick means that we're oversold. A good example is this recent market decline. We've had a number of readings that have been negative 800 or weaker, and we've continued to drift lower. So it's a little dangerous to interpret it that way. I really like to look at the distribution of tick values over time.
Okay, that's very interesting. And just to wrap things up, you just go into your own trading. Are you more of a a short-term trader, swing trader, long-term investor? And do you drive yourself crazy over your trades sometimes?
Well, it would be a problem if a trading psychologist drives himself crazy over trading. That being said, markets can be crazy making even for the most level-headed folks. But I definitely have a longer-term investment horizon for some of my money. And then in my trading capital, that tends to be short-term. I really grew up with day trading and the kind of trading that happens in Chicago with those futures markets. And so that portion of my capital, I tend to trade on a short-term basis.
Did you grew up in Chicago, you said? Did you ever work on the exchanges?
I never worked on the exchange. My first work with traders was in Chicago, and I really learned a lot from that experience. I had done my own research on short-term price patterns in markets, and was able to integrate that with what I observed and learned in Chicago. And that's really stuck with me, even though most of the people I work with now at hedge funds have a longer-term horizon.
Okay, so just to end the interview here, get in your long-term portfolio here, you getting a little nervous about the market? Are you taking profits? Or, we've had a nice decline here. Are you just looking to add some more long positions to your portfolio?
Yeah. I've stuck with some longer-term fixed income positions, which have been continuing to pay well. And as we come off here, I'm looking for opportunities to get involved, quite possibly in some of the dividend ETFs. This would be for longer term. The reason being, we're seeing economic weakness across the globe, and central banks are going to be lower and lower in interest rates for longer and longer. And I think that's going to create ongoing reach for yield. I like some of the international dividend ETFs. I think when you can pick up right here, right now, a 5% yield with some potential for capital gains, I'd like to see that represented in my portfolio.
Yeah, I think everyone would. I mean, I think people have expectations of higher returns, but definitely for the longer term, I've always been slow and steady. 3, 4, 5%. Looks paltry when you have some of these major gains, but then when you go through a period like 2000 and 2010, where people basically came out flat on their money, sometimes it pays to have more conservative investments. Well, Brett, thanks a lot for coming on Benzinga's Pre-Market Prep, brought to you by Charles Schwab, giving us a look into your books and the psychology of trading. Traders can check out your site at www.traderfeed.blogspot.com. Brett, thanks for coming on. We hope to have you on again.
I would enjoy that. Thanks a lot, Joel. Appreciate it.